In today's episode, I'm going to talk to you about a fixed index annuity that had a 20+% return and how that account was set up in order to achieve it. Now, it is a bit of an anomaly, and I'll say that just kind of as full disclosure getting started. But the point of the video is that you can set things up in a manner that are going to improve your likelihood of a return inside these products. Let's jump over to that statement now and take a look. Before we progress the statement, I want to make an important distinction about this type of annuity. This annuity is not meant to annuitize or generate an income. We are simply using the chassis of this fixed indexed annuity to protect the client from the downside of the markets. Now, as far as the upside go, if the market does have some returns, the client can capture some of that. But it's really designed to protect the client's principal and interest earned from the downside of the markets. It's not necessarily designed for income. Now, the client could decide at some point in the future that she wants to move the monies into something that would generate a lifetime income. But that is not how we set up this account. So with that said, let's jump over to the statement. As always, this video is intended for educational purposes only and not to be used as financial or tax advice. So I've got the statement open, but as full disclosure, I do want to point out that I have selected 2020's statement instead of this last year's, and that's because that year had such phenomenal returns. 318 into the market at that time was at a low, so we bought down at the bottom of the market, and then the preceding 12 months were really good, so the market took back all its value and some. So this is not your average year inside this type of account, but the point of the video is to demonstrate that not only do these accounts provide downside protection, but also when the market does have good years, we can take back quite a bit of that return. So I'm going to scroll down here to the fund selection and performance page, and the first thing you'll notice is that we split her 275 across two different funds. Both of them are tied to the S&P 500's performance, but one's a cap and one's a par. Now, cap is limited on the upside, and for this strategy, it's 5%, which means if the market returns 10%, the client's only keeping 5%. But why would we do that? That's because there's a guaranteed rate. If the market returns 0 or negative, anything less than 4.4, then the client is going to receive 4.4. Now, the second fund we chose is the S&P PAR. PAR stands for participation rate, which is the amount of money that's eligible to receive whatever the market returns. And in this case, that's going to be 66%. So if you had a $100,000 investment into that fund, 66,000 would be participating. If the market returns 10%, you would have a 6.6% return. So moving on down to the next section, we can see how the returns from the stock market are calculated. We're going to start with this first fund. We'll notice that 137.5 has become 127.5. The reason is because the client had to make withdrawals from this account in that year. But I would always recommend you wait until after your anniversary date, because the life insurance company, even if you held that 10K she took for 11 months, if it's removed before the anniversary date and the credit take place, it is not eligible for those returns. So you want to wait in your withdrawals. Now, if you have a monthly withdrawal set up for income, it's fine, don't worry about it. But if you can hold off, then do it. She only takes income from this, makes a withdrawal once a year. So she needs to wait until after the calculation takes place before making that withdrawal. Now we see the market, we bought in at $23.98 at a market low, and we ended up on a credit date market price of $39.15. Now that's a 63% change, right? So on half the money, we only earn 5% because we want to make sure if it's negative, we at least get that 4.4. And so we only took 5% home, which was $63.75. On the second half, the money is where the magic happened. So it's that same 127.5. These numbers are the same. It was a 63% change. The difference is that we get to keep 66% of what the market returns less the company spread. So they're going to take the first 2%. So the calculation for this is pretty simple, and I'm going to open a calculator to show you guys. And so what we do is we just take the market's return of 63.27 and we multiply it by 0.66, and then we subtract their 2% spread from that. So minus 2, and that's the 39.75, which we should see right here. 39.75, we round up on that 5 to 6. All right, and if you apply that to the 127.5, it is a $50,694 return, which is phenomenal, a 40% return on half of the money in the account. So I'm going to keep scrolling down the statement, and here in this next section are the options available to us. The first is the fixed account, and the interest paid on less than 100K is 2.25, and over 100K is 2.55, which is pretty good. These should be higher considering interest rates have gone up so much since then. The next two we know a lot about because those are the ones we just discussed. The two we're splitting that 50-50 allocation across, the S&Ps. And then the last is the BlackRock Endura 2-year. Now, important distinction, 2-year versus 1 year. I do not recommend 2 years, and you have to be careful here. The reason why. This client's a perfect example. If this client had a 2-year strategy, she would have had to wait a whole nother year before she finds out whether or not she had a return. Remember what happened here. At the end of that first year, the market came way down, and she reset on that market's low. So now with that low point in mind, when the market went back up, she took back that return. The difference between those two was your return. If you have a 2-year strategy and the market came down, well, she wouldn't have a reset at that time. She'd have to wait a whole nother year to figure out whether or not she had a return. By that time, the market was already back to where it was when she started. So there would be a minimal return, if any. A 1-year strategy, in my opinion, is better because it will reset more often and therefore give you a better chance at locking in those earnings, or at least resetting on lows, so that the difference between that, because the difference between that low and that new high is what you'll earn. So there are a couple big takeaways. The first is that the allocation was limited to 4 options, and we didn't want to go with that fixed account because 2.5% wasn't bad, but the client has protection against the downside, so we wanted to go ahead and roll the dice. We did go with the S&P 500 split. Now, some might ask, why didn't you go 100% into the participation rate? And the reason is because if that year was down like last year, at least the client could walk away with something. Obviously, hindsight 2020, we wish we did go with the 100% allocation, but you want to diversify when you can. And then lastly, we had that BlackRock, but we don't like 2 years because we want to reset as often as we can, provided that there are good cap rates and participation rates. You know, if they look a lot better in the 2 years, maybe there's a chance, but mostly I've found that the 1-year reset is going to be your best option. Now, getting off into the performance, well, we did pretty good. I mean, we had a 40%, nearly 40% return on half of the monies. We only saw 5% on the one portion, but 40% was really great. That boosted the client's annual return to about $57,000, and across the 275 contribution, I mean, we were looking at, I think it was almost a 21% return, 20.75 if I'm not mistaken. Which is awesome. One thing I would recommend is not making withdrawals within that first year, but after the fund has calculated, after the anniversary, because we saw that it wasn't 137.5 on each of those strategies that were included toward the calculation for the returns, but instead 127.5 because the client made the withdrawals before the end of that first year. So if you can, you want to put that off until after the anniversary date. So here we saw how a fixed indexed annuity could be set up not to annuitize, but simply offer the client protection from the downside of the market on principal and interest, while also providing some pretty good returns. I mean, imagine being able to take back 66% of whatever the market returns with no downside risk. Market makes 10%. Sure, you've got to give up 4.4% in her case, but you walk with 6.6, almost 70% of whatever the market returns, and no potential for loss. It's not a bad deal. On the other half, we saw a 5% cap. I mean, that's not as great when the market does have those big returns. However, when there are losing years, that client had a minimum guaranteed interest rate of 4.4%. So not a bad place to be for retirees who have shifted their priorities. They were looking for growth, then conservation, and now the priority is conservation, then growth. And so if you guys have any questions, feel free to reach out. Leave a comment here on the social channel you're watching this. Thanks for tuning in, and hopefully we catch you on the next episode.